Hello there, this is forexbrokers.net and we continue our trading academy with the Elliott Waves theory. The next topic, or the topic that we will cover, refers to corrective waves, more precisely to zigzag patterns, as we will cover all the types of a zigzag in a bit of a theoretical fashion here, and then explained on the weekly US dollar and Japanese yen in order to see how a zigzag translates into price action and how to interpret the different types of zigzags. A zigzag is a corrective pattern. It can be either bullish or bearish, and it is labeled with letters, not with numbers. A zigzag is an A, B, and C, something like this, and it is always labeled with letters. Now, depending on the cycle or the degree that the market forms a corrective waves, these letters have different colors if you use a color code, or different size if you use a different font, in order to identify different cycles. So in this case, this is how a zigzag looks like. A, B, C. You can have an A, B, C, a zigzag part of a rising trend, or you can have an A, B, C or a zigzag part of a falling trend. The principle is exactly the same, is similar, with no changes. So this is a bullish zigzag on the left side of the chart, and this is a bearish zigzag, that the market just formed. There are some conditions on a zigzag that one should consider, and the most important one is that in a zigzag, waves A and C are impulsive, So this is wave A, which is impulsive, wave C that is impulsive. Also wave A or wave C in a bearish zig, they are impulsive. For this reason, zigzags are considered to be one of the most trickiest patterns of them all, because the temptation for every trader is to label it as an impulsive move, not as a corrective wave. For instance, if you see a strong move like this, the tendency is to label this one as the first wave of an impulsive move. If you don't know what's an impulsive move, feel free to review a bit what we've done so far on the Elliott waves analysis, on the impulsive waves. So 1, 2, so that would be the tendency, and then the third wave to be the move here on the upside. But that's nothing but wrong, especially in the case of a zigzag. So wave A impulsive, wave C corrective. So a zigzag, as a matter of fact, has not only one impulsive wave, but it has two impulsive structures, wave A and C, and for this reason it is very difficult to be interpreted correctly. The B wave of a zigzag is the only corrective structure. It can be a simple correction, so this is corrective. It can be a simple correction, or it can be a complex correction. Also, at this point, you may go and see the difference between simple and complex corrections. What types of complex corrections are possible with the Elliott waves theory? Complex corrections with a small X wave or with a large X wave, double combinations, triple combinations, and so on. The B wave can be a simple correction, can be a triangle on its own, can be a flat on its own, and can be also a zigzag on its own. So you may have a zigzag as the entire pattern, but you may also have a zigzag for the B wave, for instance. One of the most important things to consider on a zigzag is the so-called time element. Normally, this is the time that it took for wave A to form. We should project that time on the right side from the moment that the B wave starts, and the C wave should take approximately the same time, not more, not less. Of course, this being the currency market, then you will see some differences between waves A and C, in terms of that you should be, in the sense that one should be flexible, not necessarily waiting for the exact number of candlesticks to be the same, but look more for an approximate length in time or duration in time for the C wave and wave A. This is one of the most important conditions in a zigzag. The B wave in a zigzag rarely retraces beyond 38.2. So look for the B wave to end, or let's say the B wave should retrace less than 38.2 of wave A. Obviously, it can retrace 50%. It can go even 61.8 sometimes. There's nothing wrong with it. Only that the more it retraces, the more questions the trader should have on the ability or on the power of interpreting a zigzag, because in a zigzag the minimum retracement for the B wave is 1% of wave A. So rarely it goes beyond 38.2. Often it goes 23.6, but rarely it goes 38.2. And if the price is able to go more than 50%, then you will have a hard time interpreting a zigzag moving forward, especially because of the time element, the equal time that you need to have between wave A and C. The same thing applies on any zigzag, on a zigzag to the downside. For instance, here this would be wave A, and this would be the time that it took for the C wave. In this arrangement, this is a zigzag. The condition for the B wave is that the length of it should not end beyond 61.8. If the B wave ends beyond 61.8, the market forms a flat pattern, and it will make wave A corrective, not impulsive. The B wave can travel beyond 61.8 in a zigzag, but it should not end beyond 61.8. For instance, it may be that the B wave is a terminal impulsive move that ends with a triangle, and by the time that the triangle ends, the first segment of the triangle dips below 61.8, but the end of it is above 61.8, maybe even above 50%, and that would bode well with the zigzag rules. Stay tuned for the next part, as we will go into the types of a zigzag and what the particularities of a zigzag are. Bye bye.